Hey, good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. First day back after the winter holiday break. Okay, so remember, anything said in this piece is an opinion only. It's not investment advice, not financial advice. Okay, so this is Driving Markets, driving while talking about markets. To all those new viewers and subscribers, the idea is to give you a little bit of a market brief, a market wrap, a market indicator based on my opinions where we're going to go. Remember, let's recap that 2022 was quite a difficult year as far as financial markets are concerned. No one expected interest rates to rise as much as they have risen. At the beginning of 2022, interest rates globally were more or less flat, maybe 0% or 0.15%, very, very low interest rates, which allowed liquidity, allowed a lot of flow in the market. A lot of investors, a lot of traders took out high-risk investments on the back of low interest rates, investing in all types of things, whether it was the high-tech sector, the high-risk shares, or cryptos, or bitcoins, ethereums, or high-risk commodities. So a lot of investors thought, where can we make money if we're getting nothing in the bank? Let's put it to work. And that's what happened for the last 10 years. Then in January, February, March, everything turned around. Why? Because there was an undercurrent of inflation building up globally. It's not to do with the Ukraine or Russia-Ukraine war. What Biden and the liberal progressives want to blame is they want to blame Putin for inflation. Putin was not the cause of inflation. What was the cause of inflation was liquidity, cheap money, stimulus packages from Corona, stimulus packages post-Corona. The 2008, 2009, 2010 quantitative easing, printing of money, all that has built an undercurrent of inflation, cheap money, and lots of it has therefore given the investor or given the trader or given the man in the street huge resources to go and buy property, to go and buy high-risk shares, to go and buy cryptos, and that's pushed all of those asset prices higher up until 2022. 2022, all of that changed. The environment changed, everything changed, and what you had all of a sudden is moving from a bull market into a bear market. So the Dow, the Nasdaq, the S&P, the UK FTSE, the DAX European markets all fell. They fell because money became more expensive. As rates rise, obviously it costs you more to borrow that money from the bank or from lending institutions. And the biggest victims of that, or the biggest sufferers of rising interest rates, are the high-risk assets. The high-risk assets, like all of those stocks in the Nasdaq and cryptocurrencies. So what happens is, as the money becomes more expensive to borrow, those shares fall because they're totally dependent on cheap liquidity in order to fund themselves. And effectively, what you had is a major collapse in the high-tech sector, and that's likely to get more severe and more critical this year as cost of money rises even further. Now, with inflation as an undercurrent of inflation coming in from 2021, the invasion of Russia into Ukraine, all that did is frustrate the inflation model even more. So therefore, everyone began to blame Putin, but it wasn't really Putin. Putin did aggravate the situation, but he wasn't the cause of it. And talking about the war, Russia-Ukraine, it's unlikely that that's going to finish in the near future. If anything, I would put my money on, or bet on this year, that because of America's weak response, and Biden and his liberal progressives are so weak and have got no international understanding of what the heck is going on, the probability is that China is going to invade Taiwan. Yes, China could invade Taiwan in 2023, especially during the Biden administration, because obviously that would not happen if Trump was in power. But because Biden's so weak, it is very possible that China will invade Taiwan and take advantage of the weakness, and that will send further cataclysmic tsunami waves across financial markets. That could happen. Furthermore, looking overall at the undercurrent of inflation and interest rates, you're going to have rising inflation throughout 2023. With rising inflation, the central banks will have to raise interest rates even further. I don't believe that inflation is under control yet. It will take the whole of 2023 to bring inflation under control, with increasing interest rates at a much higher level than we have at the moment. So I expect interest rates in the US to probably go to about 7% by July, in the UK to 5%, 5.5%, in Europe also about 5.5%. That will cause the cost of borrowing, and the pressure on the consumer will be huge, because more and more money will be leaving their pocket just on housing and accommodation, never mind talking about food and energy prices, which are on the constant up due to major supply problems. The other issue to look at is the new XBB COVID variant, which has come out in China and apparently is resilient to many, if not all, of the vaccines. Now, and they're saying it's far more contagious. So we're not going to go into another lockdown. I don't believe any government will go into the lockdown. However, they are restricting travel from China, or asking for more stringent tests for those people who land in China from the States, and starting off in some European countries. However, it's probably too late, because the XBB variant is already out there, and it's going to have a further impact on European and global markets. So take that into account. That's also a risk in 2023. What will happen to the corona? Obviously, China has opened up, and as a result, that variant is moving around a hell of a lot. Okay, so you're going to have probably another global pandemic, but I don't believe that you're going to have a actual lockdown in the US or in Europe, because simply the economies and the governments can't afford to have another lockdown anywhere in the world. It's just too expensive, and it's going to kill off any type of economic recovery. Looking at certain asset classes, I think you can have a stronger dollar in 2023 with rising interest rates, and also a run for cover if there is a global crisis. And you're also going to have falling cryptocurrency value. So I'm calling Bitcoin down 2023 to around about the 7,500 level, round about there. Interest rates have already stated. You're going to have commodity prices. Gold, I expect to go to above $2,000 in 2023. It looks pretty bullish at these levels. It looks like it wants to move higher. So that's a very, very, very interesting one when you go on gold. Okay. Also, in terms of other precious metals, all depends if Russia expands the war or if China invades Taiwan. All of that seems a bit far-fetched, but remember last year when I was stating in January, February that rates will rise by 4.5% by year end, that was also far-fetched, and I got a lot of pushback on that from a lot of viewers, a lot of subscribers, and a lot of comments. What I plan to do is do some live shooting. So what I'll do is I'll send out a quick message on WhatsApp and any other media that I have regarding live, and I'll give you, say, a 7 days notice for you to get ready, and we can have some interaction on a live YouTube, which hopefully will give you a little bit more substance and maybe have a bit of a question answer session that will allow you to trade in a bit more detail and understand markets a lot more than you do at the moment, hopefully. Okay, so this is Mayor Valensky with Driving Markets, driving while talking about markets. I would like you to subscribe, comment, pass it on, share it. Speak to you soon. Have a good day.